The stock market is just so much noise, right? You've got tips, you've got hot trends, you've got constant chatter. So, how on earth do you find the truly great companies in the middle of all that? How do you spot the long term winners and ignore the short term hype? Well, that's exactly why every serious investor needs a proper toolkit. And we're about to open it up. Okay, first things first, we need to get one thing straight. We are not talking about short-term trading. That's a whole different game that often uses what's called technical analysis, looking at charts and patterns trying to guess the next price swing. Nope. Our focus here is on long-term investing, and that's the world of fundamental analysis. The goal isn't to time the market's mood swings, it's to figure out the real solid value of the business itself. So that's the big question, isn't it? If you're going to ignore all that daily market noise, how do you actually find those rock-solid companies, the ones that have a real shot at growing over years, not just a few days? Well, the answer is a disciplined approach.
And that approach has a name: fundamental analysis. The best way to think about it is like being a detective for a business. It's a method for digging deep and figuring out a company's intrinsic value, what it's really worth. You do that by looking at everything. I mean, everything, from its financial health to the people running the show to its position in the broader industry. You're basically understanding the business from the inside out.
Now, you can think about fundamental analysis as looking at a company through two different but equally important lenses. Each one gives you a unique perspective, and to really get the full picture, you've got to use both. So here are our two lenses. First, we have qualitative analysis. You can think of this as the art of investing. It's all about judging the things that you can't just slap a number on. Then you have quantitative analysis. That's the science. This is where we get our hands dirty with the hard data to see if the company's story actually holds up. Let's dive into the art first. All right, so let's put on that first lens, qualitative analysis. This is all about getting a feel for the business story itself, the strategy, the brand, the culture, and the people making the big decisions. So what are we looking for here? You're asking yourself things like, are the people in charge actually good at their jobs? Do they have a vision? How powerful is the brand? I mean, do people know it and trust it? What's the entire industry looking like? And maybe most importantly, what does this company have that its competitors don't? What's its competitive advantage? And that last point, the competitive advantage, that leads to probably the most important question you can ask as a long-term investor. In a world full of competition, what actually protects a great business from rivals who want to come in and steal its customers and profits? And you know who has the absolute best analogy for this? Warren Buffett, of course. He calls it an economic moat. It's brilliant. Just like a real moat protects a castle from invaders, a strong competitive advantage, like, say, a super powerful brand or a unique patent, protects a company's profits from its rivals. Finding companies with wide, unbreachable moats, that's the heart and soul of qualitative analysis. Okay, so a great story and a wide moat, that's fantastic. But the numbers have to back it up, right? This is where we switch to our second lens, the science of quantitative analysis. This is where we check the receipts and make sure the company is as healthy as it claims to be. And look, if you're new to this, don't be intimidated by the numbers. The easiest way to think about a company's financial statements is just like its yearly health checkup with a doctor. They give you a clear, no-nonsense look at what's really going on inside. So in this checkup, you're really looking at three main reports. First, the income statement. This basically asks, is the company making a profit? Simple as that. Second, the balance sheet. This is a snapshot in time that asks, what does the company own and what does it owe? And third, the cash flow statement. This one tracks where the actual cash is going. And trust me, this one is crucial because, let's be real, profit on paper is nice, but it means nothing if you don't have the cash to pay your bills. All right, I get it. Reading those statements line by line can feel like a total drag, and it can be overwhelming. That's why smart investors use financial ratios. They're basically shortcuts that help you quickly understand that health checkup report and see how a company is doing compared to others in its field. First up, the big one, the one everyone talks about, the price to earnings or PE ratio. This is a key tool for valuation. It simply compares the company's stock price to how much it's earning. Now, it's not a magic bullet, but a really high PE might hint that a stock is a bit pricey, while a low one could mean it's on sale. It's a fantastic starting point for asking that simple question: am I paying a fair price for this business? Okay, next up is return on equity, or ROE.
Now, this one is all about efficiency. It tells you how good the management team is at turning investors' money into actual profits. A company that consistently has a high ROE, that's often a sign of a really well-run, high-quality business. And last but definitely not least, we have the debt-to-equity ratio. Think of this one as your risk meter. It shows you how much the company is relying on borrowed money to run its business. A super high DE ratio can be a major red flag because it might mean the company is in a fragile position if the economy takes a downturn. You're looking for a healthy, manageable level of debt. So when you bring these two lenses together, the art of understanding the story and the science of digging into the numbers, what do you actually end up with? What's the big picture?
Now, this is super important, so I want to be crystal clear about this. Fundamental analysis is not a crystal ball. It will not tell you what a stock price is going to do tomorrow or next week or even next month. It is not a tool for timing the market.
Instead, think of it as your compass. Its entire purpose is to help you find and identify truly great businesses, companies that are well-managed, financially strong, and protected by one of those durable economic moats. It points you in the direction of quality. That's how you build a solid foundation for long-term investing. And that really brings us to the core of it all. So I want you to forget about the stock ticker for just a second. Using these two lenses, the art and the science, what business out there do you truly believe will not just be around, but will be thriving 10 years from now? And why? Because answering that, well, that's when you stop just looking at stocks and start thinking like a real long-term investor.